Growth in the United States is set to weaken and remains low in China. Although energy constraints have eased somewhat in the euro area, recession risk is high. Additionally, a number of developing economies face debt distress, exacerbated by tighter global financial conditions. Policy normalization has accelerated, and monetary conditions are likely to tighten further to ensure that inflation declines from its current high rates. With long-term borrowing costs high and fiscal positions extended, there is little policy space available for major counter-cyclical efforts to increase economic growth. In several economies, including South Africa, ongoing consolidation of fiscal positions will support disinflation. Asset values in major markets have also declined sharply, and investor appetite for riskier assets remains weak. Taking these and other factors into account, the SABC's forecast for global growth in 2023 is revised lower to 1.9%. The International Monetary Fund's October forecast for global growth is 3.2% in 2022 and 2.7% in 2023. We now expect the South African economy to grow by 1.8% this year. Despite considerable volatility in monthly indicators, GDP growth of 0.4% is still expected in the third quarter. Fourth quarter growth is forecast to be only 0.1%, largely due to record load shedding. Over the medium term, and despite stronger private investment, the forecast takes into account lower commodity prices, higher inflation, and interest rates. On the supply side, the forecast incorporates an assumption of increased load shedding, which could deduct 0.6 percentage points from GDP in 2023. As a result of these factors, the economy is forecast to expand by 1.1% in 2023 and by 1.4% in 2024, which is below previous projections. GDP growth of 1.5% is forecast for 2025. With a low rate of potential, our current growth forecast leaves the output gap slightly larger in the near term before closing in the third quarter of 2023. After revisions, the risks to the medium-term domestic growth outlook are assessed to the downside. Commodity price movements in recent months have been mixed, with oil prices relatively stable and export prices lower. Compared to September, our oil price forecast is broadly unchanged, averaging $102 per barrel for 2022 and $92 per barrel in 2023. South Africa's export commodity price basket has come down from earlier peaks. As a result of weaker export developments, the current account balance is expected to be negative 0.2% of GDP this year, falling to negative 1.5% in 2023 and negative 1.9% in 2024. The current account balance in 2025 is expected to be negative 2.1% of GDP. Although near-term fiscal risk has eased on the back of better tax revenue, a weaker commodity price trajectory than currently expected could increase risk. Financing conditions for rand-denominated bonds have been generally tight and more volatile in recent months. 10-year bond yields currently trade at about 10.7%. Policy normalization in major economies and the slower growth in China have contributed to depreciation of many emerging market currencies, including the rand. The implied starting point for the rand forecast is 17 rand 76 cents to the US dollar, compared with 16 rand 91 cents at the time of the previous meeting. Globally, economic growth is slowing, and prices have fallen for some goods and transport services. However, price pressures continue to spread from goods to services and wages. Our estimate for inflation in the G3 is revised higher to 7.3% in 2022 and 4.1% in 2023. The forecast for 2024 is unchanged at 2.1%. Even though South Africa's fuel price inflation for the year remains exceedingly high, some easing of global oil prices has led to the forecast revisions in the last few MPC meetings. Fuel price inflation for this year is now forecast at 33.3%, falling to 0.8% in 2023. Local electricity price inflation is slightly higher at 10.7% in 2022, 9% in 2023, and is unchanged at 10% in 2024. Global food price inflation has declined. However, local food price inflation is revised up due in part to the weaker exchange rate and is now expected to be 8.8% in 2022. Food price inflation is revised higher to 6.2% in 2023 and is unchanged at 4.2% in 2024. The bank's forecast of headline inflation for this year and next is slightly higher at 6.7% and 5.4% respectively. In 2024 and 2025, we expect headline inflation of 4.5%. Our forecast for core inflation is unchanged at 4.3% in 2022 and is higher than previously expected at 5.5% in 2023. The forecast for 2024 is unchanged at 4.8%, and 4.5% is projected for 2025. Services inflation is broadly unchanged and continues to be driven by expected spillover effects and steadily rising unit labor costs. Core goods price inflation is forecast somewhat higher at 5.7% for next year. The forecast for average salary growth is broadly unchanged. Risks to the inflation outlook are assessed to the upside. Despite easing of global producer price and food inflation, Russia's war in the Ukraine continues, with adverse effects on global prices generally. The oil price market is expected to remain tight, with upside risk to prices. Electricity and other administered prices continue to present clear medium-term risks. Given low public sector wage assumptions and high petrol and food price inflation, considerable risk is still attached to the forecast for average salaries. Higher than expected inflation has pushed major central banks to accelerate the normalization of policy rates. It has tightened global financial conditions and raised the risk profiles of economies needing foreign capital. G3 interest rates levels for the forecast period are now expected to be significantly higher than in September. On balance, and with few exceptions, capital flows and market volatility will be elevated for emerging market assets and countries. While the rand has recovered somewhat, it has depreciated by about 7% year to date against the US dollar. Inflation expectations increased strongly over this year and remain high. Expectations of future inflation surveyed in the third quarter of this year had earlier increased to 6.5% for 2022 and 5.9% for 2023. Expectations for inflation in 2022, based on market surveys, has increased to 6.8%. By contrast, long-term inflation expectations derived from the 5-year break-even rates in the bond market have moderated to 5.27%. In the second quarter of this year, inflation breached the upper end of the target range and is forecast to remain above it until the second quarter of 2023. Headline inflation is only expected to sustainably revert to the midpoint of the target range by around the second quarter of 2024. The forecast takes into account the policy rate trajectory indicated by the bank's quarterly projection model. As usual, the repo rate projection from the quarterly projection model remains a broad policy guide, changing from meeting to meeting in response to new data and risks. Against this backdrop, the MPC decided to increase the repurchase rate by 75 basis points to 7% per year with effect from the 25th of November 2022. 3 members of the committee preferred the announced increase. 2 members preferred a 50 basis points increase. The level of the repurchase rate is now above the level prevailing before the start of the pandemic. The revised repurchase rate remains supportive of credit demand in the near term, while raising rates to levels more consistent with the current view of inflation and risks to it. The aim of policy is to anchor inflation expectations more firmly around the midpoint of the target band and to increase confidence of attaining the inflation target sustainably over time. Guiding inflation back towards the midpoint of the target band can reduce the economic costs of higher inflation and enable lower interest rates in the future. Achieving a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage growth in line with productivity gains would enhance the effectiveness of monetary policy and its transmission to the broader economy. Economic and financial conditions are expected to remain more volatile for the foreseeable future. In this uncertain environment, monetary policy decisions will continue to be data-dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on potential second-round effects and the risks of de-anchoring inflation expectations. The bank will continue to closely monitor funding markets for any stress. This concludes our statement for today. And at this stage, I would like to invite members of the media here present for the first time since January 2020 to pose any questions that they might have. Who is the first volunteer? Please identify yourself and the media house you represent, and then you can pose your question. There is a battle of the two ladies. Renee?
I've got the mic, Governor. Thank you very much. I'm Renee Volgraaf from Bloomberg News. Governor, at the October Monetary Policy Review, you mentioned in your speech that the SARB is not ahead of the curve on policy normalization. After today's move, where do you see the SARB in terms of being ahead of the curve or not, or behind the curve on policy normalization?
Prinesha?
Governor, it's Prinesha Naidu from Bloomberg News. I have quite a few questions for you. Firstly, you have for the first time given us steady state forecasts, and in this, you have a repo of 7%. What exactly does this mean? And also GDP growth at 2.5%. I then want to know whether you still see the policy stance as accommodative. Inflation, your forecasts, you said, are slightly higher for the next year or so. It appears sticky. How concerned are you about persistence and the potential second round effects? And how assured are you that inflation expectations will come down to the midpoint over the forecast horizon? And two questions related to the Federal Reserve's minutes yesterday. They signaled they're probably going to cool the pace of hikes, shifting to 50 basis points in December. How, if anything, would that influence the MPC's thinking or deliberations when it comes to the repo rate? They also flagged the risks of over-tightening. So I just wanted to find out from the MPC a bit more how you're thinking when it comes to weighing the trade-offs between fighting inflation, growth, and the growing burden on consumers. And that is it for me. Thank you.
Are you sure?
It depends on your responses, I guess.
Is there another one? Let's take the last one. Chris, you are in steady state, my friend.
Hi, Governor and Governors. It's Kopano Gumbi from Reuters News. Just following up a bit on what my colleague Prinesha just said, I'm curious about your views on how inflation has now become more of a domestic challenge than when we started the pandemic, and it was assumed that inflation would be imported, especially when we look at how the numbers came out yesterday with inflation going across the basket, and what you think your response might be going forward relating to that. Thanks.
Thank you very much. Renee, are we ahead of the curve? Are we on the curve? Are we behind the curve? You could only tell that with hindsight. Because remember, we determine policy based on our inflation and growth outlook and the risks attendant to that. Since the September meeting, many of the risks that we had identified had materialized. Amongst those risks was faster tightening of policy by the advanced economies. It was inflation in the advanced economies remaining sticky, and it was. It was the possibility that the tightening of policy, faster tightening of policy by the advanced economies, central banks, would result in depreciation of the currencies of developing economies. And we have seen those materialize. And with that, you have to recalibrate policy accordingly. So we take a view that the policy adjustment that we have made now is consistent with the forecast and is consistent with the risks that are attendant to that forecast, and that we continue to be data dependent, and as new data comes in, we will recalibrate policy as appropriate. And that is how we think about this. Financial stuff about the policy stance and whether we think that the policy stance is still accommodative. We believe that the stance that we have will still support credit growth, whilst at the same time dealing with the inflation that is ravaging the incomes of South Africans. And so, where are we? The inflation figure came out yesterday as, at 7.6, and the policy rate had been adjusted with effect tomorrow to 7%. So if you look at today's inflation, the policy rate is still negative in real terms. That says that it is accommodative. It is another though, because for next year, we are forecasting inflation of 5.4%. And so on a forward-looking basis, we would have just turned marginally positive to the tune of 1.6%. And that becomes important because that is roughly the policy horizon of 12 months, which means that the calibration of policy now should have effect on the inflation outcomes of the following year. And of course, like all things in economics, other things being equal. And those other things being equal in our case here are the risks that we had identified. And should those risks materialize, we are going to then have to reconsider policy as the data actually comes out. Is inflation in South Africa persistent? Can't say definitively that it is persistent. What we can't say is that it is temporary. We can't say it is temporary, because then if it is temporary, monetary policy should do nothing. But we are seeing evidence that inflation had been rising over the past 12 to 18 months. Give you an idea that in 2021, when we experienced growth of some 4.7%, the output gap was still marginally negative. Actually, not say marginally, because it was negative to the tune of 2%. But what we had was that actual growth was faster than potential GDP growth. We saw the same situation this year, that actual growth is forecast to be faster than potential GDP growth. It's the same story into 2023, even as growth slows down, that actual growth will be faster than potential growth. The result of that is that we expect the output gap to close in 2023. A closed output gap says to us that inflation might soon catch up with us, and you can't wait until you see that the output gap had closed, but based on your forecast, you then take a view about that. Secondly, we have seen that there has been this narrative in South Africa that says, oh, this inflation is just external, it's just supply shocks and so forth, and you must look through it, which is what we did from early 2021, that we looked through these shocks until we saw that there was evidence that inflation was beginning to be broad-based, which is when we started to adjust policy in November. And so, if you strip out the two items that are said to be the shock, being energy prices and food, we still find that core inflation has risen significantly from what we had seen over the past 12 to 18 months, and yesterday surprised when it hit 5%. If anybody wanted a measure that inflation was beginning to be broad-based, that would be it. Unfortunately, there is nothing we can do about October's inflation or September's inflation. That is water under the bridge. We can do something about future inflation, and
Reserve Bank Governor Lisicha Kganyago announcing there that the repo rate has now gone up to 7%. That's up by 75 basis points.